Afternoon, everyone. Okay, so I think from the earlier discussions that the other speakers have had, it seems like there's a lot of uncontrollables that happen with shares. So, for example, share might decide to go down, share might go up. But the one thing that we can control, which I think is quite an important part that we sometimes forget. I mean, me being a tax advisor, I can't forget it because otherwise I'll probably get fired. But I mean, it's tax essentially if you think about it. Because the thing is, you kind of know how much of tax you would probably be paying once you make a profit or a loss. Okay, sorry, I'm just trying to. Oh, there you go. Thank you. So, Albert Einstein said the hardest thing in the world to understand is income tax. I mean, that guy was a genius. So it makes me feel like a super genius since I understand a bit of tax. And I mean, the tax back in the day was like a small piece of legislation as opposed to what it is now. And if you think about it, if you look at the newspaper and stuff, SARS is always trying to do something somewhere, try to get more revenue in to obviously help facilitate the economy. So tax is an important part of investing. Now, the problem with tax is that it's very legal and very complex, and it's based on various pieces of legislation and case law and so forth. So, from an understanding point of view, I mean, we got the sections, all of these sections here that generally go through the gross income definition, chain reduction formula, section 24J, and so forth. And I think for purpose of this, I'm going to try and only speak about the relevant stuff. So for me, based on all of that, I think Section 9C is probably one of the more interesting stuff that will probably make a big difference in your lives as you invest on the stock markets. So the important thing from a tax, if you just take it all the way back to the basics, is that you need to figure out whether you're going to be taxed on a capital or a revenue basis. Now, the problem with being taxed on a revenue basis, that's your marginal tax rate. So if you think about that table with the marginal tax rate that goes from 18% all the way up to 40%, that's your revenue rates. Whereas for a capital side, you actually get taxed at a lower rate, so that's your capital gains tax rates. And that's where you ideally want to be if you are investing on the stock market. However, it's very difficult if you think about it from a Stokvel perspective to actually fall into the capital situation. I'll explain why shortly. So one of the important things from a revenue capital side is what is your intention? So they look at what is your intention as a taxpayer when you're actually investing as part of a Stokvel. Now what they say, they like to use this word called scheme of profit making. Now if you think about it from a Stokvel perspective, if you're investing in a Stokvel, you are trying to make a profit. I mean, I'm pretty sure there isn't anyone here at all that enters into a Stokvel to try and make a loss. I mean, it would defeat the purpose, essentially. So that's one of the main criteria where they say, look, if you're in a scheme of profit making, it will be seen to be revenue in tax. So now you're thinking, okay, great, that means I'm getting charged at my marginal tax rate. And the thing is, you don't actually look at your marginal tax rate as saying, okay, this is my Stokvel income, this is my income that I get from my salary. It's actually everything together. So for example, if you get a salary and you get something from the Stokvel, you actually add the two together and you figure out what marginal rate you are. So it ranges anywhere from 18 to 40%. So if we look at the income tax calculation, what you guys will be doing, so you go to your gross income, you take your salary and you add the Stokvel profits that you guys have made. Hopefully they're all profits, no losses, because you guys have learned so much from this morning session. So we're going to say only profits. You reduce any exempt income. Now exempt income is your dividends income generally, your local dividends income. So they say, okay, fine, whatever dividends you receive, we're not going to tax you on that. And then you get to your income, and you reduce it by any deductions or allowances that you may have. And following that, you add any taxable capital gains. And you start paying tax from 70,700. So that's after the rebate. Once again, do not forget that it's not your Stokvel. So if you haven't made profits of 70,700 from your Stokvel, you're okay. If you're working, you need to bear in mind that other stuff as well. Okay, then we get to your CGT, which is where if you were, like, for example, if you have a property, for example, okay, generally no one really trades in property unless you are a property trader. So whatever you sell your property for, that will be your proceeds for CGT purposes. So for example, if it's 2 million, so that's That would be your proceeds that you would get, less your base cost being whatever you paid for your property. Then you get your capital gain or loss. Hopefully it's capital gain. I'm just saying because of the quality of people we have here, we're only making capital gains and profits. We're not making any losses. Okay. Following that, you would include it, and essentially what you would include it at is the different inclusion rates. Now you see for individuals, your inclusion rate is slightly lower compared to a company or a trust. Okay, so for example, if you make a 2 million rand profit, you'd include a third of it in your individual tax return and times it by your marginal tax rate again. So if you're at the maximum tax of 40%, you would technically charge 13.3%. Okay, so the one thing that I learned just from having discussions with various people that came through to the table that we had and were asking, why are you here being KPMG kind of thing, was there seems to be, with the Stokvel environment, it seems to be that we go to a bank, open up a joint account, a Stokvel account kind of thing, and we just contribute to that, and that's it from a structuring point of view. Now, the thing is, for tax purposes, the way you structure something is quite important. So depending on what you do, they could have different impacts. So for example, the ways you could do it is, if you're doing that Stokvel accounting, that's generally going to be seen as being like a partnership kind of interest. The other alternatives that you could use are trusts and companies. Now, from a company perspective, that's going to be quite administrative. You need to have audits and all of those good things, and it's generally a bit more of a more taxing structure depending on what's happening kind of things. I mean, I know the Minister of Finance has recently introduced like a small business incentive that's trying to now make it more exciting for people to use companies so you can get bigger benefits kind of things. But for purposes of today, I left that discussions out. So as I mentioned, with the way that the Stokvel seems to be currently happening, where we have a joint bank account, it seems to be following more of a partnership kind of environment. So the important thing to remember, as I think Simon alluded to this morning, a partnership isn't a legal person. So it's important in the case that it means that it forms part of your individual income and so forth, and following that. So partners have an undivided share in a partnership asset. So essentially you take all of the assets and depending on how many partners, divide it equally across the board. And the income you receive from the partnership, so whatever dividends you receive as part of the Stokvel investment that you guys do, will accrue to the actual investor, being, for example, you or me that's investing in the Stokvel. Okay, then expenses can be claimed by the various partners if there are any expenses to run the Stokvel, bank fees, administration costs, so forth. And they will be taxed in terms of Section 24H, which essentially just means there's a flow-through kind of thing happening subject to various things, and you get taxed at your marginal rate once again. I think I'm going to leave this one out. So the one important thing to note is that usually from a legal perspective, and this is where legal and tax differs, is that from a legal perspective, you have a partnership, and let's say there's 10 people, including me, and I decide to leave the partnership. From a legal perspective, the partnership seems to have been stopped or dissolved essentially. And then you would have to start a new partnership with the remaining 9 people. From a tax side, I actually don't see it like that. Essentially what they would see is that you would have a partnership and it carries on. So that's how SARS sees it from their point of view. So it's just an important thing to note. Okay, then obviously we got the trust structure, which has different types of trust, and I'm going to go mainly into discretionary and vesting trust. And the important thing to note is that trusts are charged at the maximum threshold being 40%. So trusts are charged flat at 40%. And if you think about it for individuals, the maximum that you can be taxed is at a 40% rate. And the inclusion rate is also slightly higher. Now the thing is with the trust is, if you have a vested trust, so that means if you have beneficiaries that automatically get the income. So there isn't any discretion by the trustees to say, you know what, I'm not giving you the income this year because I want to keep it in a trust. So if there's that automatic flow through kind of thing, then that's what they call a vested trust. And essentially what happens is, because everything flows through, it seems to be like a pipe, if you think about it, and it's like water flowing through the pipe. So if you have water at the top and water at the bottom, the beneficiaries are seen to get water. If, for example, if you decide to pour Coke, which I hope for me there would be Coke. So if you pour Coke at the top, the beneficiaries will be seen as getting Coke at the bottom. So, for example, in this instance where the trust receives dividends with the vested beneficiary, the dividends would have accrued to the beneficiary and not the trust. So that's important from a vested trust point of view, where the trust isn't taxed in the vested concept in this instance. It will go through to the individual. Now, you might think, what's the importance of that? But it comes through with respect to interest, for example. So remember, as being an individual, we get an interest exemption, annual interest exemption of 23,800 rands, for example. So if the trust receives the interest of 23,800 rands, and it's seen to have flown through the trust, then the individual would actually be getting the 23,800, which you can use the annual exemption to offset against that. So, for example, with a discretionary trust, so that's where the trustees can decide to retain it in a trust or distribute it. Now, in this instance, if you have a look at the picture on the right, so the trust receives the interest on the 1st of Feb 2015, and if they don't distribute it in that year of assessment, so before the end of Feb, because the trust and the individuals both have the same tax year end, it would mean that the trust actually gets taxed on the interest, and you can't use that exemption, the individual exemption. So that means for the 23,800 rands interest that you receive, the trust will pay 40% of that in tax. Whereas if you distributed, it would have gone through to the individual, and the individual could have used the annual exemption of 23,800 to offset against that. Okay, so leaving the structure part alone, so if you just look at shares, so as I mentioned, the starting point is whether it's revenue or capital account. Now, generally with a Stokvel, you're going to be falling into the revenue part. But there is a section, being the Section 9C, that actually allows you to change the intention based on if you meet these requirements. So what Section 9C says is, if you have an equity share, right, so that's a share, like for example on the JSE, or interest in a collective investment scheme, and if you hold it for a continuous period of 3 years, you have been deemed to have disposed of it on a capital account. So if you think about it in your ordinary sense of the Stokvel, so if you keep it for 3 years, for a period of 3 years, you automatically fall into CGT, which will be at a lower rate. So I think that's quite important, because I think from my discussions earlier on, seems like a lot of people dispose of it within a year and that kind of stuff. So instead of getting taxed at the higher rate, you could get taxed at a quite lower rate if you keep it for a period of 3 years. And then dividends that are received from shares are exempt, so all local dividends, so you don't get taxed on it. And then there's also a partial exemption for foreign dividends, which works on quite a complicated formula. The one important thing with dividends today is that there's dividends withholding tax. Okay, so that means every time you get dividends in your hands, so for example, let's say someone declares dividends of 100 rands, the company is obliged to withhold 15%. So that means at the end of the day, you only get 85 rands. Okay, so that's just the one important thing to bear in mind in that respect. And then I think Mark was talking about exchange traded funds earlier on being the exchange traded products. And the legislation around it is quite complicated from that point of view. But essentially what happens is that it will seem to be also like a flow through, so almost like a trust as well. So whatever income you get will be seen to be similar income. And then the same with when you dispose of the unit. So when you dispose of the ETF, essentially, you'll have a CGT or a revenue event on that. Okay, so the one thing I wanted to discuss, which I thought might be useful because this is something that the JSE has recently done as well, is REITs. So REITs are real estate investment trusts. So the nature of these kind of shares is that they're like a growth point and so forth, so they invest in property, and the main underlying factor from it is that they distribute a lot of the income as dividends through to the people that hold them. So generally their dividend yields will be quite high, and from that perspective it might be quite interesting and might be tempting to invest in those kind of shares. The one thing though is, from a tax perspective, what happens on our side is that the interest distributions, so the distributions you get from the REITs, are seen to be dividends. Now the thing is, remember earlier on I said that dividends received, local dividends received, are exempt. With regard to a REIT, they wouldn't be exempt, they would be seen to be taxable, which is quite an important thing to factor into your calculations as well. because as opposed to it being subject to dividend withholding tax being at 15%, it's now subject to your marginal tax rate. So if, for example, you are sitting with a 33% marginal tax rate, the tax effect of you receiving that dividend is slightly higher. Okay, so that's just something you just need to bear in mind when you are looking at investing in a REIT kind of thing, just to make that extra calculation and be like, is the actual dividends that you're getting, does it still make sense, or do you rather go into a normal company and just get the exempt dividends? Okay. And then once again, there'll just be a CGT event upon the disposal of your interest in the REIT. So when you invest with the REIT on the JSE, as soon as you dispose of it, there'll either be a CGT or revenue event, depending on where you fall into.